On today's episode, we're going to talk about interest rates. I know, not something you want to talk about, but I promise I'm going to make it, if not fun, at least interesting. We're going to be really quick. We're not going to belabor it, but I thought I would share with you. So stick around and let's talk about interest rates. All right. Okay, welcome back. Happy New Year to all of my finance friends. I am Robin Moore, the owner, the originator, as it were, of More ABC Financials, where we take care of your accounting services, your budgeting solutions, and your customized database needs here. All of my information is down in the description box, but let's talk about interest rates. Interest rates are a topic of discussion among lots of folks. And, you know, I was talking to my good friends over at Total Freedom Solutions. Hello to Anika and Ngozi. They are Total Freedom Solutions. I have probably picked their brains on a lot of things mortgage, just because they both have a background in understanding mortgage solutions, but really they do kind of a comprehensive financial services offerings for both businesses and individuals. I will also leave their information down in the description box. But here's the example that we were talking about, and we discussed, and I came up with a scenario that I thought would be an easy way to understand what the whole deal is with interest rates. Why should you care? There's nothing you can do about it anyway. An interesting post that I had on Facebook a month ago, maybe a couple months ago, late 2022, is, interest rates are really good when you're the person loaning the money, when you have savings, or when you have money making financial instruments that are making you money. Interest rates going up is a very, very good thing. When you are the person that is borrowing, meaning it's going to cost you more money to borrow funds, interest rates can get scary. And I want to, with More ABC Financials, we can certainly delve into some specifics with your personal situation, whether it be for you yourself or for your business. But here is, I think, a simplified way to think about it. And I'll kind of start at the beginning. So prime, right? Prime rate. What is this prime rate? It has nothing to do with Amazon, actually. It is the rate that you can find in the Wall Street Journal. Actually, I got a letter from one of the banks that I deal with, and the new terms and conditions is, your interest rate is going to be prime. And the prime that they're using is actually going to be coming out of the Wall Street Journal. Shout out to Florida A&M School of Business. We were required to read the Wall Street Journal, so very, very, very familiar with the Wall Street Journal. So the prime interest rate is set by the Federal Reserve. It is the rate that most influences how banks are charged, or what rate rather banks are charged for money that they borrow in an overnight rate. We can get into that in another video. And so it is, therefore, if it is the rate that impacts the banks, it unfortunately or fortunately, again, depending on whether you're the lender or the borrower, for those that are Bible readers, you understand that reference, the interest rates that the banks are charged influence things like home equity lines of credit cards, auto loans, personal loans just through the bank. And that's why I wanted to show you this example of how interest rates impact our lives, and more specifically for 2022. I know it's already 2023. I know. So I want to talk about what happened in 2022. Why the buzz about interest rates in 2022? So to understand and kind of get a grasp on the most recent history in our finances, you have to know that pre-COVID or pre the panini we found ourselves in, the rates in 2019 went up 3 times, I believe. So in 2019, the rates went up 3 times. And that was before there was a lot known here in the US about the virus and the things that happened after we found out what was going on. And so we saw in the beginning of 2020, there was a response to lots of things going on in the world and therefore in our financial markets. And you see that we saw a small decrease or smaller decrease of about 0.5 point at the beginning of 2020. And then we saw 2 weeks later, a week and a half, really, an entire 1 point reduction of interest rates. Things were going crazy. We could not get goods. There were shortages all over the place. And so we had some huge economic slowdowns with the closings of businesses around the world. And that was the federal government's response to the slower, not inflation, but deflation to our markets. Again, we'll talk about all of that later. That's not what this episode is about. I want to get to 2022. So in the middle there, you see once that rate dropped to 3.25, right? 3.25% was a pretty low rate. And that rate stayed through it. It did not move. And you see there on the chart, it did not move for 2 years. For 2 years, the federal government was not willing. We did not have enough data. We had no idea what the world was going to do, what the markets were going to respond, how we were going to survive this thing. Frankly, we were in true survival mode. And here that walks us to 2022, right? In 2022, the stair step that you see, and I'm going to shift myself over so you can see this increase once the rate started going back up in March of 2022, every about month and a half, some were more frequent than others, but every about month and a half, we had a rate increase in 2022. And that was fast. Considering where this is the federal government making a decision on what's going to happen in our market. Every month and a half to increase that rate was a big deal. We were not used to the government signing off every 6 weeks or so with another rate increase. There was never a decrease. It was always an increase, meaning we knew what was going to happen, but we were hoping that some of these smaller increments were going to tamper some of the inflation we were seeing in 2022. And I wanted to bring an example to you that is probably the most personal to a lot of us, and that's home ownership and what that would have looked like in 2022. Home ownership can be a very exciting, fun experience. It is always overwhelming. It is always complicated. There are so many factors. Oftentimes there is a person on the other end, unless you're buying brand new from a builder. You're almost always buying from another person who has their own set of complications. You have your own set of complications and needs. Some are ready to move now. Some need some time. So there's oftentimes so many things that go into purchasing a home. And this example, I think, hits home in for us as we look at what would have happened in 2022 if we were buying a home? And we all know or know of someone who purchased a home in 2022 and how crazy that market is. Look at those rates over and over again, increase upon increase. Remember, a home buying experience is not straightforward. The financing for the house oftentimes precedes you even finding a house, meaning you've been approved for a purchase and now you've got to go and find a thing that matches that price. So let's take an example. And again, I'm going to try to make this as quick, I think, as I can make it. And we're gonna call this price point 400,000. Now, in different markets, that means different things. If you're in California, that's really cheap. If you're in probably South Georgia, 400,000 probably sounds like a mansion. But 400,000 is, I think, a good starting point. I think it strikes home with a lot of us. We can picture a $400,000 home in our head. This is the picture that that I picture when I think 400,000. I'm thinking land, a big 2-story home. I'm thinking a large home for $400,000. At the beginning, and again, this is just an example. Feel free to reach out more. ABC Financials is more than happy to walk through some of these specific things to your own situation, or if you want someone to bounce some ideas off of on how we get there, how we get ourselves in a better position to take advantage of some of the things that are going on in the market, feel free to reach out. So $400,000 at the beginning of the year before rates started going up. Rates were 3.25%, $400,000, excluding taxes and fees. I know that's a whole other thing. I'm going to exclude it for simplicity's sake for this example. Your mortgage in a 30-year fixed mortgage would have been $1,741. Just call it $1,750 every month for 30 years. You would then pay the bank back the $400,000 that you borrow. And if you look at those rates, again, every 6 weeks or so on average, the rate was going up. If you had waited, or if your financing expired and you needed to reapply, by June, that same 1741 really, but 1750 would have been nearly $2,100, 2087, right? That is in 6 months, that is a 346, call it $350 difference between what you would have had as a mortgage at the beginning of the year to what you had in the middle. And the end gets even crazier. At the end of the year, for financing $400,000 at 7.5%, which is where we ended 2022, that mortgage would have cost you $2,797, $2,800. Now, remember, we started out with $1,750. That is almost an $1,100 difference from the beginning of the year to the end of the year. Let's be very clear. A lot of consumers, let me say it correctly. A lot of consumers are not going to have, if that scenario happened, you had a thought, you had some approval at the beginning of the year. You said, okay, I'm going to go and find this $400,000 house. Say it took you some time to find it for whatever reason, and say you didn't find it until the end of the year. And if you had to be reapproved for finance, or if you had to go back through the process, the current rates, the difference between what your bill would have been at the beginning of the year and your bill would have been at the end of the year is $1,100. A lot of consumers would not have been able to just say, okay, well, my mortgage is now $1,100 more expensive than I anticipated it was going to be. most times you have already a budget for the mortgage, meaning the $1,750 that was the amount at the beginning of the year is what you basically could afford comfortably that fits your lifestyle. And so let's flip that scenario, because not everyone's gonna just be able to say, I want this house and I'm willing to pay whatever. It may not be in your budget. So what likely has happened to folks who are in this scenario is they could no longer afford the $400,000 home. So I'm going to give you the real world numbers to what would have happened is if the rates increased the way they did, if you still thought you want to be in the market, you want to buy a home in the market as it were, instead of spending and having access to $400,000 for your home financing, you would have only been able to finance $250,000. Now, I know in your mind you have pictured a $400,000 home. Now let's picture a $250,000 home. You are basically paying the same money, depending on the timing of when this financing went through, what's going on with the interest rates, a difference between a $400,000 home and a $250,000 home. Same mortgage, $1,750. One is at the beginning of the year where rates were 3.25, and one is at the end of the year where rates were 7.5%. And that really is the scenario. I want to say it's not intended to be more of a gloom or doom message. I wanted to show you real world examples, real world implications of what interest rates mean. When we save our money, when we make decisions about our finances, when we make financial moves in our businesses, interest rates and positioning matters for sure, 100% for sure. And this is just a small example of how fast things could change depending on what that interest rate is and depending where you are positioned in the market. So again, this is Robin Moore with more ABC Financials. I hope you have gained something out of this example. I thought it was really neat, real life example that I think is a stark. I think the numbers really give us a peek into what the implications are of interest rate that we just don't think about because the numbers are so small, 3.25% to 7.5%. If you don't know what that means, it could mean you could get locked out of some things that you otherwise had already budgeted in your mind. And we want to make sure that you are positioned well. So until next time, make sure you take care of others, but also make sure you take care of yourself. Talk to you soon. Bye.